Hi, this is Kelley Wright at the Money Show in Dallas. Joining me today is a man who really needs no introduction, but I'm going to do it anyway. The godfather of technical analysis, Mr. Ralph Acampora. You've made more calls on more markets over more time than probably most of us combined. So, now that I have the opportunity to meet you and get to sit down and talk with you,
yes, Kelley.
Where is this market going?
Well, I made a presentation yesterday, and I basically said that I like the long-term trend of the market.
Okay.
And that was based on the leadership, based on the performance of the Dow Theory, which is an old
school
that I look at.
Yeah.
That means that both the industrial and the transportation have been making new highs,
confirming
which they
each other,
and they did recently. But I have to tell you, Kelley, I was a little concerned about yesterday's sell-off, that 200-point decline on the Dow.
Okay.
But more importantly, the NASDAQ down about 2%. And again, a little bit more weakness today as we dialogue. And I don't think anyone should be surprised that we had some kind of a sell-off.
Sure.
I mean, the market's been overextended for a while. But what I want to share with everybody is that it's not the declines that concern me, it's the subsequent rallies. Now, any kind of a rally we get from this sell-off near term has to make new highs. If not, a week or two or three or a month from now, I could be saying, gee, there's some negative divergences.
Okay, so for those of those who are watching that aren't well versed in technical analysis, you have an impulse and then a decline, and then on the next impulse, it's important that it eclipses the previous
high.
The previous high. Okay, and then if it doesn't, that tells us what exactly?
Well, then you're going to start seeing laggards. You're going to start to see the inability to make new highs. Wall Street, the stock market, abhors failed rallies.
Okay, because it's weakness.
And it gives an opportunity for the sellers to sell into strength.
Right,
and that's what guys like me are looking for, to suggest that maybe there's a more meaningful change in trend. As we have our conversation right now, I don't see it. I see this is near-term noise and long overdue, actually.
Okay.
The correction. But as I said, I want to see the next rally.
You know, we're kind of in a different world. 1982 till probably the summer of 2016, we had the greatest bull market in interest rates and bonds in the history of finance, I think.
Yeah.
Okay. That's clearly over.
Yeah.
Okay. The Fed is now normalizing. They're not only incrementally raising Fed funds, they're withdrawing some of the liquidity. With interest rates so low for so long, we had some adjustments in the market and vis-a-vis how investors valued stocks versus fixed income.
Yeah.
That's got to revert to the mean some way, somehow, doesn't it, or am I wrong?
No, you're absolutely right. Unfortunately, we don't have a graph. I have a graph of the 60, 70-year history of interest rates. And what you're talking about is in the 40s and early 50s, when rates were down on this level. And then they started moving up. And so did the stock market.
Right.
In fact, we had a secular bull market in the 60s, and the Dow peaked in 1966. Yes. And you know where interest rates were?
I have no idea.
5%, not 3%. So my red line, and I tell this to everybody that cares to listen, my red line is not 3% kills the bull market, it's 5%.
So you're talking about the 10-year?
Yes.
Okay.
Yes, but we're going to have corrections like this, and people are nervous. I have to tell you something that happened to me. I was on a TV show about a year ago, and this young fellow next to me, panelist, he was crying. He said, "Oh my heavens, mortgage rates are going to 4%." I looked at him like he was crazy. I said, "I bought an apartment in New York City in 1994. I paid 10.5%, and I kissed the bank, and they didn't charge me 12%."
Sure.
So, please, rising rates are
read a book, study some history.
Yes. So yes, people are going to get nervous, and they're going to say rising rates are going to kill the real estate market. That's crazy.
Yeah.
If you need a house, you'll pay 4%, you'll pay 5%, you'll pay even more as time goes by.
That's relatively cheap money compared to, oh Lord, I remember, what did T-bills get up to, 21%?
Yes.
First mortgages were 18?
Yeah.
5%'s a walk in the park, isn't it?
Oh, absolutely.
Okay. What a thrill and a pleasure. Mr. Ralph Acampora. I'm Kelley Wright at the Money Show in Dallas. Thank you so much.